Most people think IRS audits happen because you're making too much money. That's simply not true. I'm going to walk you through things I see every single year as a CPA, and it has nothing to do with breaking the law. It has everything to do with how you prepare your tax return. See, the IRS doesn't audit emotions. It audits patterns, inconsistencies, and ratios. And if you understand exactly what they're looking for, you could substantially reduce the amount of taxes you owe legally and without getting in trouble. My name is David Zareh. I'm a CPA of almost 15 years, and I'm going to walk you through exact steps to watch out for when submitting your return so that you pay the least amount in taxes without getting in trouble. And this is all legal. Before we dive in, let's kill the biggest myth first. Making more money does not automatically increase your chances of getting audited. The IRS expects high earners to pay less taxes as a percentage. That's literally how the tax code is written. What they don't like is when the numbers relative to each other don't make any sense. Think of the IRS like an algorithm that asks one simple question. Does this return look similar compared to other returns like it, or does it look completely different to returns that are supposed to be similar to it? And if the answer is no, that's where the problems start. Okay, audit trigger number 1, taking losses year after year after year. Losses are totally allowed. What's not allowed is pretending a hobby is a business. If your business keeps showing losses year after year with no path to profitability, that's when the IRS obviously starts asking questions. They want to see intent. They want to see that you're actually trying to make money, because no business for 10 years just loses money to reduce your taxes owed. Obviously doesn't make any sense. They want to see intent. They want to see marketing spend, equity contribution, purchase of assets. They want to see that you're actually improving your business in a real way, and this is all shown on the tax return. So yes, you could push the envelope, but if you push too hard and you get audited, you're gonna go through a big mess. Audit trigger number 2, S-Corp payroll that makes absolutely no sense. This is one of the most aggressive audit triggers I see, and it's very common. If your S-Corp is making $300K a year, let's say, and you're paying yourself, $25,000 in salary per year, it's a clear red flag. The IRS requires reasonable compensation. Yes, you want to reduce your self-employment taxes by paying yourself less salary, but you're supposed to be paying yourself market rate for that position. Not pay yourself what you feel like you want to pay yourself, but specifically what someone else would earn reasonably if they were doing your job. This is one of the easiest things for the IRS to challenge, and one of the easiest things for the taxpayer to actually lose. Audit trigger number 3, 1099 mismatches. This one is so brutally simple. This ties back to the inconsistencies we were talking about. If a company reports paying you $50,000 and they issue you a 1099, but then you go and report to the IRS that you got paid $20,000, the IRS sees that inconsistency, and it's the easiest way for them to send you a letter in the mail and say you owe more in taxes. Most audits don't even start as audits. They start as automated notices that get sent directly to you in the mail. And if you ignore these notices, it's going to escalate. You're going to owe more in penalties and more in interest. It's not a good idea. So make sure what people report on the other end, you're reporting the same and it matches. Audit trigger number 4, aggressive tax credits without documentation. Credits like ERC, fuel credits, niche tax credits, they're not illegal, but they are heavily scrutinized. The issue isn't eligibility, it's documentation. If you can't prove how you qualified, how you calculated it, and how it directly applies to your situation, the IRS will disallow it. Same goes for charitable contributions. You can't just write on your tax return, I donated $500,000 and not have any documentation. This is another area that's easy for the IRS to scrutinize, and if you can't support what you put, you're just gonna pay more penalties and more interest. IRS audit trigger number 5, home office deductions. This one is way more common than people think. Home office deduction requires regular and exclusive use for business. So if you have a space, like an apartment or a home, and you want to say, well, I use 50% of the house or apartment for business purposes, This is easy for the IRS to scrutinize and say, hey, this doesn't really make sense. So that means things like your den, your kitchen table, your guest room, you guys cannot include that as part of your home office deduction expense. This is something that TikTok has made super popular, that you could just write off where you live, but this is going to lead to trouble for you. Make sure you're doing it right. Make sure you have documentation, the square footage, and support how you come up with the calculation. Now that we know the mistakes to avoid, let's talk about how to reduce your audit risks without paying more in taxes. Here's the part that most people miss. It's not actually about being more conservative. It's mainly about being clean and consistent and the story making sense. That means clean books, logical ratios, matching third-party reporting, documented strategy, and record keeping. The goal is to pay less in tax without looking stupid on paper. Keep in mind, the IRS is reviewing hundreds of millions of tax returns every single year. So they actually have a great grasp as to what's going on. It's just a matter of what are they willing to let seep through the cracks. Lastly, let's clear up exactly what does not cause an audit. I want to make sure there's no confusion here. Making a lot of money does not cause an audit. Being self-employed does not cause an audit. Taking legitimate deductions does not cause an audit. Taking an aggressive tax stance does not cause an audit. The IRS does not punish success at all. Just follow what they say. For example, if you have to file sales tax or if you have to file estimated taxes, just do as they require. What they do punish is sloppy reporting. So follow what they ask and stay under the radar each year. So if you have no idea if your tax situation looks risky or clean, that's a big problem and you don't want to wait until the IRS decides that for you. Yes, the goal is to always pay the least amount in taxes, but you don't want to take 2 steps forward and then 3 steps back. If you're focused on growing your business and growing your wealth, year after year, add another strategy, reduce your taxes, but do it in a clean and surgical way. Avoid at all costs going under an audit. It is not worth the amount of taxes you saved, and it will cause you tons of trouble in your life. If you have questions about if you think this or that is risky, comment down below. I'll answer you directly. And if you thought this content was helpful, please subscribe. I'm going to be doing a lot more videos just like this one. See you guys in the next video.